First, quick check on the markets. You can see a lot of red on this board. The Russell's the outlier, up about 0.5%. The Dow pulling back fractionally right now. The S&P down about 1/3 of 1%. The Nasdaq down more than 0.5%. And on jeopardy of breaking its 13-day win streak. That's one of the win streaks we were talking about, Joe. Obviously, a lot of this action follows the president saying that an extension to the ceasefire is unlikely. Also making some other comments saying a lot of bombs would drop if the ceasefire isn't somehow resolved. Excuse me. And over the weekend, the U.S. taking an Iranian ship into custody. Are you surprised the markets aren't pulling back even more with that?
No, I don't think I'm surprised because the market has proved itself with a very strong degree of resiliency throughout 2026. So this is just playing to the script. The VIX is still below 20. The price of oil never got above where it was early Friday morning when we broke down at $92. To see today that technology, momentum, growth is taking a little bit of a pause after 13 consecutive up days, that's normal. That's exactly what you would want. Now it's time for the S&P equal weight to kind of join and participate, the Dow Industrials to join as well. You have 52-week highs today in stocks like FedEx and Target and State Street and eBay outside of the technology names. So not surprised by the resiliency at all. Very consistent with the script for 2026. And I'll say this, it's tough to be a bear.
It is very tough to be a bear right now. Brent, I want to come over to you. One of the things I was looking at, if you look at the VIX today, it's actually lower than it closed on the day before the Iran strikes. Is that complacency? Is that resilience? How would you categorize that when we're seeing a market that doesn't seem to be concerned, even as geopolitics and some of the tensions there, they just continue to ramp up?
Right. I mean, this goes back to what we've seen across most wars or whatever we're going to call this, invasions, et cetera, is that the market quickly digests the fog of war. And I think one of the reasons, outside of a huge amount of short covering last week, a ton of, we'll say, mechanical systematic buying, is the 10-year. I mean, the 10 years at, what, 425, 426? And so I think that 10-year being so well anchored and actually falling about 10 basis points over the last week tells us that, to me, what the market thinks around inflation. And so to me, as long as that 10-year stays around these levels, that's very constructive for stocks. And I think also what's interesting, if you go back to 2023, we've had 5% drawdowns, and we get this whipsaw up every time where within a month we're above that prior peak. We hit that again, and every time the market has gone meaningfully higher. And so I think to Joe's point, it doesn't get that much more complicated. This market is incredibly resilient because we have low yields and earnings to back that up.
All right, Steve Weiss, I want to come over to you. As I mentioned, some headlines that would make, I think, a normal market or a market any other time kind of waver a bit. Trump goes to Bloomberg, ceasefire, highly unlikely to be extended. I keep saying suspended, extended. The U.S. also struck and seized an Iranian-flagged cargo ship. I mean, certainly, if you were someone who said, oh, I think it's going to be resolved in a few weeks, it doesn't appear that way anymore. Are you surprised by the market action? Where would you go if you wanted to put money to work?
Well, first of all, I'm going to challenge your initial characterization of a pullback. This is nothing. I mean, we've had the quickest move from oversold to overbought in 40 years. And this is nothing. This is like a blemish. This is not a pullback. Look, I think that the market's appropriately ignoring what comes out of D.C. and what comes out of Iran. Number one, in terms of D.C., you just haven't been able to believe anything that's come out of there. It's all hyperbole, and a lot of it isn't moored in facts. So, and that's true of Iran, of course, as well. So what's the best thing to do? The best thing to do is look at history. History is, as Bryn pointed out, these geopolitical excursions, always end up better for the investor than if you reacted during them, right? So if you take the longer-term view, even an intermediate-term view, then I think you're going to be okay. I think at this point, Trump, has not reading his mind, difficult to do, has some regrets and does respond to market action. So I've got to believe that somebody's telling him, if he doesn't realize it himself, what the market would do if we bombed the energy infrastructure in Iran. you'd see inflation really spike up and stay there for a long period of time. So the market, again, is appropriately ignoring that possibility and sticking with what they know. So when you see markets sell off like this, it's an opportunity to buy. I think at this point, better hold on to your capital. Everybody knows you're going to have a great quarter in terms of earnings, 12 to 15%, depending upon who you're listening to and what your own analysis is. And there's always an opportunity to buy. But given the move we've had, I wouldn't be surprised to see, as we talked about on Friday, Joe, I wouldn't be surprised to see a little more of a pullback.
You know, Weiss, I actually agree with you. I mean, today's nothing compared to the rally we've seen over the last 13, 12 days, however you want to categorize it. Rob Sechan, how do you view everything? How do you view the fact that the VIX is actually lower than it was before all this started? Oil seems to be under control, and we're hearing some very bullish calls on industrials, tech. I mean, how are you viewing this market?
So, two things. When we went into this crisis, we had seen many stories play out on don't fighting the White House. They always pivot. They end up coming back and listening to markets. The other thing that we know is don't fight what the market is telling us. And the market is telling us that you want to buy these bottoms. The Mag 7's up 20% since the lows. We've had a V off the lows that's been twice as fast as the drawdown. It almost looks like a check mark. Cyclicals are leading defensives. Transports are at new highs. Credit spreads are contained. And sentiment, absent today, is still generally bearish out there based on positioning. So I think the pain trade is still higher, frankly, even though we're extended and overbought, as Steve has pointed out. And yet this is in the face, so equities definitely want to go higher. In Atlanta Fed GDP now, which is 1.3%, has more than halved since the war started. The market does not care. Does not care.
But does Rob Sechan care?
Atlanta GDP is always
and so, okay, listen. The market does not care. I can tell you that. Many are still underway. You look at Deutsche Bank positioning, it's barely moved off the bottoms. And so you're having this institutional chase. And so there is so much here right now that is predicating on a positive outcome here. But it seems like the probabilities that if you're listening to the White House, which has been a bad bet to bet against, and if you're listening to the markets, to bet against. And so here's what we're doing. Let me just talk about positioning. Buying durable growers that are the beneficiaries in all this, because earnings in the market are extremely narrow, but they're fundamentally well supported. So we are way overweight the semis, way overweight the durable growers, the hyperscalers.
Well, you're answering my question. Where are the durable growers? Is it just tech? I mean, according to Goldman right now, Q1 earnings are tracking to be 12% higher year over year, with tech contributing to about 85% of the growth.
So why wouldn't you lean into that? Because it looks like not only are they delivering, they're beating on those expectations. So, you know, we own 6 out of the 7 Mag 7, sans Tesla. Okay, we own 14 to 18%, I think 18% of our total portfolio in semis. We are bet there. We also have some cyclicals. We have some energy as kind of a hedge to that. But this is kind of how we're thinking about it. It's worked well.
All right, so Joe, you look like you're thinking. Ran, you're raising your hand. Sorry to cut you off, but go ahead.
Position and sentiment, to me, are always two very important, powerful forces. So you're identifying that technology is going to be the overall lion's share of the earnings growth in this 12% plus quarter. Think about positioning. Did anyone anticipate that in terms of the way they were positioned 6 weeks ago? Or were people actually stepping away? Were people saying, no, we don't want the Mag 7? Not you, Steve. I know you wanted the Mag 7. But then you've had this very rapid rebuild in position in exactly the right place. You wanted it to happen in the Mag 7, in growth and technology, to validate the possibility that you could extend and make new all-time highs, and that the market was going to continue to have this script of resiliency and look past the headlines that are coming from the Middle East. Why? Because the valuations got cheap enough in technology. The valuations got cheap enough in the semiconductor industry and for the Mag 7 itself. And it became so overwhelmingly appealing when you knew that what you were going to be greeted with during this earnings season is continued remarkable earnings growth.
In an odd way, that ratchets up the risk, because I'm not sure that given the move that they've had, particularly in Microsoft or maybe in Meta, that they can tolerate a disappointment. So the expectations are now very high.
Fair.
I was not concerned about the expectations, 10, 20% ago with those names, but now I am.